Coming up in this show, Ivory brings you a sample of our Future Speak show, a member video with analysis on crude oil, which is negative. Also, see how you can give the gift of askSlim to somebody you know that loves the markets or to yourself, and we're going to give you back an Amazon gift card. And I'm going to show you short-term analysis on the stock market, VIX, SPX, NASDAQ, and the Russell, with a special look at our market monitor. And we asked the question last week, is the rebound over? Well, now that answer is clear.
Well, I'm going to the city and I'm gonna do a silly show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone gliding, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in the next week, and hopefully lots of great ideas and opportunities for you throughout the show.
Stock market lost ground last week, undoing the huge upside spike after Powell's speech the previous Wednesday, which seemed less hawkish. However, stronger economic data and a big uptick in talk of a coming recession in 2023 brought renewed selling. Monday and Tuesday were big down days as Salesforce got downgraded, which hurt the Dow. Also hurting the Dow were declines in oil stocks as OPEC Plus held their 2 billion barrel cuts, and the oil market tried to rally but then turned down sharply, and oil stocks came down with oil. Also, Meta fell 6% on Monday as there were talk that the EU, they were targeting them regarding their ad model. So a lot of things came down that also affected the NASDAQ. Add to that, at the Goldman Sachs Symposium, banks warned of a coming recession. Wednesday, we saw weak data out of China and more sellers in stocks. And there was a 5-day pullback through all of that, which saw the S&P 500 fall 4.4% from peak to trough. So a pretty significant pullback. Thursday, the market tried to rebound on hopes that the PPI would come out Friday, showing more softening inflation. But that was actually a disappointment, as the PPI actually showed hotter numbers than was hoped, with the headline number up 0.3% and the core up 0.4% for the month. Futures, they had been up 20 in the morning, anticipating that on Friday, but then fell to minus 35 points fast. Now here, as we do this recording at midday, they're just slightly to the upside. What's very interesting in markets this week is a change in correlations. Bonds versus stocks is what I'm talking about. And they're back to acting inversely, which we really saw for decades. But this year, as bonds fell, stocks fell with them on the higher yields, on the tighter Fed, and what was really a major change, a major policy change for the Fed. In the last week, all of this recession talk, well, bonds and stocks, they parted ways again. Bonds moved up, but stocks didn't follow. So we had an inverse correlation again. As long-term bond yields fell this week, short-term yields held. And that's on the expectations that the Fed still has more to go on the upside. And we're going to hear from the Fed at their meeting next week. What happened was that steepened the yield curve, well, to the steepest level that we've seen in more than 40 years. Fed funds, which on that Powell speech had dropped down to about 4.81%, popped up back over 5%. So there is an anticipation again that the Fed is heading over 5% on their Fed fund rates, and pretty likely that we're going to see a tightening through the first quarter of next year. That steepening yield curve is bad for the banks, and they look like they've peaked. and bad for earnings as a whole, which have been unbelievably bloated and false thanks to the Fed. And the repercussion of that we are seeing is there are a huge number of stocks that are down 70, 80, 90%. This is that malinvestment that happens when the Fed acts in ways that are invasive into the free market, and things happen where people invest in areas that, well, that are speculative, that we've seen tons of in the last few years, and sometimes they come apart in a very bad way. Just take a look at Carvana. What also happened, besides the fact that the Fed is pushing this yield curve steeper, is that stocks had rallied up to valuations that were pretty crazy again. We talked about that a couple of weeks ago, where we showed how these valuations had really increased again in this rally. They had made back 1/3 to 2/3 of their losses. The Dow coming back about 2/3 of the way as money moved into these bigger cap stocks. And it was just that these valuations had gotten crazy again. And that also weighed on the market. And the third reason, outside of the steepening yield curve and valuations, is that there is more and more talk about the recessions, and that in line with my expectation that besides that, there will be no pivot in 23, just a pause, probably at around 5% of the Fed funds. Now, I've read some articles this week that make a case for Fed funds getting up to 6.5%. That could happen, but I do think it's a low probability. This is going to be a tough pill for investors to swallow, and a tough road ahead for the markets. I'll show you what I think in just a few minutes, as the patterns are suggesting that stocks will struggle into year end. And a little bit of a hint is that coming in about 3 weeks is my big picture analysis, the look at what's coming for the next year in the market. I'm actually going to take the picture out even further than that. And I can tell you in this hint, I think there's a long-term drought coming for equities. I mean long-term. You're going to see more about that. Make sure you do not miss that show in about 3 weeks. Stocks for the week, indexes, they're down about 2.5% to 4%. The Russell is the worst of them as money moves from the small caps, which were getting bought before, and now have become quite out of favor as the prospect for higher rates and money moving into those kind of old stodgy stocks that are in the Dow. Bonds, pretty much unchanged on the week. 30 years were higher for the week and by a couple points, and now have pulled back to around unchanged. The 10-year yields, however, they moved up about 4 basis points. They're now trading at about 3.55%. They were as low as 3.4% after being well over 4%. So the analysis, if you watch our Future Speak show, was that we would see this time period bring these rates down to these levels, but then they'd likely be moving up again, and you have to see that in coming shows. Gold and silver also pretty much unchanged on the week. They got up into resistance and now seem to be stalling up there. And the forecast is for a minor pullback coming from these areas, especially as the prospects are increasing for interest rates to start moving up again, or futures market to start moving down again in the bond market. Dollar, small upside move, and we think that a pretty important bottom is coming soon for the dollar. That is also going to be in relation to things that we see in interest rates, which we think will be moving up again and negatively affect the metals markets. And oil crushed, down $8. I mean, just absolutely to the downside. We expected weakness, and we're going to show you why there is likely more weakness to come. Again, in the Future Speak show, which we cover all of these commodities. And also, Arby is going to give you a picture of that in just a couple of minutes. So we have some great things that are coming up in the show. Make sure that you go to askSlim.com and explore. Just look around in there. There's some great things to see. If you're new, Get acquainted with us by becoming a free member. On YouTube, subscribe to our channel, click the notification bell, and like this video. Give us a thumbs up. And on Twitter, follow us at askSlim. Any questions that you have on everything that we present here in this show, anything about our memberships, our offerings of education and analysis, write to Matt at askSlim.com. Coming up now is a great preview of FutureSpeak. This is a sample of our member video in which Ari does analysis of 24 different futures contracts and indexes. That's weekly and daily analysis with our proprietary indicators on there. And he's going to share with you what has been ongoing negative analysis in crude oil. So I think you're going to find this just fascinating. Show him, Ari.
So this is our weekly and daily cycle analysis here for crude with the weekly on the left, daily on the right. Let's go ahead and open up the weekly chart here. And as we have been noting for some time, let's zoom in. We are inside of this period of risk that is highlighted in yellow. Why is it called a period of risk? Well, it is due to the fact that we are getting late in dominant cycles. When you're late in cycles, this is where the rallies have lower odds of holding. Now, add that to the fact that we now have a weekly cycle breakdown here, right there, versus this old low that says very low odds that rallies hold. And what are we seeing? Little rally attempts have failed. We are still looking for that, and overall looking for this to trade lower into year end and likely into the early part of 2023. That next low is only due 1-2 to 213. If we jump over to that daily time frame here, you'll see what's happening. So we were looking for a low to form. We saw these long shadows on the downside. Then we finally got that rally into this falling slim ribbon, and that's really all she wrote for now here. In CL, you can see a very sharp sell that then took out the low. So at this point, what do we have? We have a still bearish slim ribbon. We have a bearish PO. So the overall short-term bias is negative here, and rallies are still likely to fail in the short term until we form this minor cycle low, which is due 1220 to 1228. Levels on the upside come in 7680 to 7930 or so. So we'll be watching for, in the near term, a bounce up here and then a move down. Let's go ahead and look at the levels on the downside. We are looking for a move down to that 7070 area, into that next minor low, and then there are levels further down, of course, right here from 6710 or so to around $63 even. So those are our levels here on the upside and downside in CL. If this were to somehow make a rally back over this old high at 83.34, then this would be a late low, and this low would have shifted out. But currently, we do not see that as the high odds case here in CL based on what we see in both RB and HO.
Great work on that. I'm sure that was really clear. And remember, you can learn our analysis at askSlim.com. Cycle analysis, very unique to the work that we do. Here is the stock market analysis. We're going to take a short-term view. But first, see how you can give the gift of askSlim. Do not miss this great opportunity. Announcing the askSlim Holiday Special, Give the Gift of askSlim for 2022. This is an amazing offering. Special rates for 3-month memberships that are non-recurring, of course, because we're giving the gift. Give the gift to someone you know who loves trading. Give the gift to someone you know who loves technical analysis. Or give the gift to yourself. Great for first-time members. Use the special to try a higher level membership if you're already a member. And there's a bonus gift for you. We give you an Amazon gift card for making this great purchase. So much to show you in here. We're going to look at this level 2 special holiday offer, 35% off for 3 months. That's only $114.75, $38.25 a month versus $59 per month. Plus, we're going to send you back $20 gift card for Amazon. You can go to askSlim.com and I'm going to show you how you can learn more information. The next one is our level 3 special holiday offer. Special $35 off for 3 months. That's $232. That's $77.33 a month for this jam-packed gift that you can give. That's a regular $119 a month, so great savings. Plus, we're going to send you back a gift card for Amazon for $50. And our level 4 special is just as great, if not better. Level 4 special holiday offer. It includes our custom Thinkorswim charts and proprietary studies and indicators. So you have to have a Thinkorswim account to benefit from this. Special 35% discount is $303.75. That's only $101.25 per month versus $159 per month regular. Plus, we're going to send you back a $100 gift card for you. This absolutely is amazing offers that we're giving now. And of course, these are non-recurring. This askSlim holiday special, give the gift of askSlim for $22 with this bonus gift for you where we send you back these Amazon gift card. Special 3-month memberships, non-recurring. Give the gift to someone who you know loves trading or technical analysis. Give the gift to yourself. Great for first-time members, or use this to try a higher level membership if you're a premium member for 3 months. Go to the top of the askSlim.com website and click that Learn More button, and it's laid out for you beautifully. You can see everything that's available in every one of these member levels. If you want more information, of course, you can write to Matt at askSlim.com. And he will be able to give you all the information that you need. I know you're absolutely going to love giving the gift of askSlim for 2022. All right, this is the stock market short-term view. We're going to look at the VIX first, and then the S&P 500, NASDAQ, and the Russell. Now remember that I'm showing you only short-term analysis right now. And I move between short-term, long-term analysis and different indexes whenever I do this show. But you can see our full, complete analysis every single day. Matt puts this out in our stock index report daily. That's weekly and daily analysis and all of our indicators in there and more. So important levels, important readings on our indicators, and all of the charts in weekly and daily in these S&P 500, NASDAQ, and the Russell. So if you become a subscriber for levels 1, 2, 3, and 4, any of those, which of course you could take advantage of in our Christmas Give the Gift special, then you'll be able to get our information every single day in the stock index report daily. All right, so let's start out by looking at the VIX. This is a cycle analysis chart for those of you that are new. And what you see on the bottom is the cycle brackets. This is just an energetic movement in the market in here. And it gives us a sense for the rhythms or the heartbeat of the market. The lines that you see on the top are how the cycles actually formed. So this would be ideal if it rallied half the way up and half the way down and came half the way down. But that's not always how it sets up. Sometimes it peaks on the left side, which we call a left-hand translation. Sometimes it peaks on the right side, which we call a right-hand translation. In this case, it was a right hand followed by a left hand, and this is very important information. On top of that, you could see these vertical lines that show you where the cycle actually bottomed, and you can see that right in here where it actually bottomed right here and actually bottomed right here. And we were projecting that there would be a short-term trough in the VIX down in this time frame, and that's what we got as it started to move up as the stock market started to move down. So we had looked for a next trough around December 1st, plus or minus a few days, and you can see that's where we got that. Now remember, VIX is inversely correlated to the stock market. So as the stock market rallied, implied volatilities came down, as you can see that right in here. Here's where implied volatilities were going up and the stock market was declining. This is all about the demand for puts or the demand for insurance on portfolios. That's why the VIX moves inverse to the stock market. And as the need for, or the sense for need for insurance goes down, then so do the prices of the puts, and the puts and calls move down in their pricing in tandem appropriately, and implied volatilities come down. This is an indication that we saw right over here that the stock market was going to begin to pull back again, and that the VIX would begin to go up again. So that's what we have projected. Now, this is important analysis. The daily trough right over here suggests that there would be a decline in implied volatilities into the fourth week of January. That is what that essentially says, is that there's likely to be a stock market rally sometime into the fourth week of January. So that's important information as we switch over and look at the stock market. So again, what this says to us is that likely we're going to get a decline in the stock market somewhere out over here in towards the end of the year, and as implied volatilities go up, and then a advance in the stock market through the fourth week of January as implied volatilities go down. Now let's see how that correlates to the individual indexes and the conditions that they are in. So this is the S&P 500, and we're also going to focus on our proprietary indicators in here, the slim ribbon and the slim ribbon PO, which is on the bottom. So we look at these yellow zones in here, which are kind of screaming at us, and those tell us when the cycle patterns are coming down in the minor cycle and the dominant cycle. That's when you get the biggest corrections in the market, and you see that right there, right there. When you get into a period where the market holds up for a long period of time and then begins to come down, but only has a little bit, a few days to go, that tells you a configuration is in place where the market's likely to go to another high. And that's what happened in here. That's why we were positive and believing that the market would continue to move up. Now what has happened is that this the S&P 500, and I'll need to get a little closer look in here for you to see, has threatened that cycle low right over here. Now I'm going to show you the NASDAQ and the Russell. They have both broken that cycle low. In addition to that, there's a minor cycle that you can see right there, and that ranges about 8 to 10 days. This was a short one at 7. This was a short one at 7 right there, and this was 9. This was 9. This right over here is only 5 days off of that low. That says to me this is a bear flag, and that the rally that we're seeing in these last few days, or the rebound off of this big 4.4% decline, is likely to fail and come out through, well, the 8th to 10th day, as you see that right over here. So we're looking for a decline of a few more days in here. This is 8, that would be 9, 10, somewhere out over here in the next few days, that is likely to take out this low at 39.13. Here is your resistances and sell zones right in here, and they're declining because this was declining. So we see a failure coming in here either today on Friday or into Monday or Tuesday, and then the market trying to rally again. But because of this formation, we are looking for a further decline, which comes out to the end of the year, where these cycles come down and nest. You can see in here these blue vertical lines that the low projects out to 1227 to around 1/4, January 4th, and that means that there is only a very small likelihood that any rally will be able to come that holds, and most likely declines will come. We had said last week that our projection on the SPY was around 386. That is the top of this support zone right over here, which is at 3865 on the SPX. So it's 386 or 3865. And this middle of that right there is at about 3792. Either of these could be where this declines to towards the end of the year. Now you'll note we have a higher track over here, and based on what I showed you in the VIX, this next advance is likely to come out towards around the 3rd to 4th week of January. So that means that the next advance will either get up to where we believe that 4150 area of resistance would be right up over here that we talked about, or stalling somewhere around these last highs over here at maybe 4060, 4070. So it's a pretty good likelihood that we're going to see a failure in here, an attempted rally out over here somewhere, which would be, in my opinion, a very high probability short sale for short-term traders, and then a move downward again in towards the end of the year. So like I said, getting down to that 3906.54, which it got very close, is a negative occurrence. I'm going to show you on these next two charts how it broke down already on the NASDAQ and the Russell, and it's setting up weakness through the end of the year, and also as we see in implied volatilities in the VIX, and advance towards the end of the year. So we should see rising implied volatilities through the end of the year. When I switch over here and look at the NASDAQ and the X, you'll be able to see very similar pattern in here, except for the fact that this is a little unusual, as it formed a megaphone right in here, as it had this break in here that was false and then moved up, and then it came down again. So that confirms this low. Again, what we're looking for is this rally to fail. This one has gotten to the sell zone right over here and is likely to come down again, and in a choppy motion, very likely to get down to this level here around 11,260, 11,270, somewhere right over there in the NASDAQ. So it's at 11,680 right now, and likely through the end of the year to get down to that 11,260 area. And to getting through this resistance is a very low probability here. As we see that getting under 11,503 is a negative breakdown and gives us a sense that the market is in negative condition. Now, if you look on the bottom here at the slim ribbon PO, this is still giving those positive signals. It did the same thing on the S&P 500, and you can see over here where it was negative in red, how it was continuously going down. This says to me that, well, maybe you get a little bit, this test down over here, and then it tries to rally again. But at some point in here, the slim ribbon is going to cross over. That 8 will get below the 13, and this will turn blue. And then when it becomes really negative, they will all align on the downside like you saw right over here, and it will turn red and turn the slim ribbon PO as red. Slim ribbon PO is a proprietary indicator for our level 4 and level 4 plus members only, and available to use on the thinkorswim platform. So that is important information that you can have. Now, this is getting very close to neutralizing, as you can see right over here on the slim ribbon, as we are getting into these sell zones. The probability of another decline coming is extremely high when I look at this. And again, our target down over here towards year end is about 11,260, right down over here at what is the halfway move from this low here to this point right over here. So that is a look at the NASDAQ, the NDX. Now the Russell is giving a similar story in here. We'll just take a look here at these last cycles where it is pointing to even maybe a little bit weaker situation, as it has gotten clearly below that 1820.71 low right in here some number of days ago. It's not even really able to flag, as we see happening. It's more a bearish looking triangle, and this is very likely to come down again here. It doesn't even look like it could get into the sell zones. This one is the most negative, acting as a turn neutral, as you can see here on the slim ribbon PO, and very soon could go negative in here. So we're looking for a best case decline of 1770 here in the Russell, with a pretty potential move at 1740, pretty good potential to coming down right over there. Again, the ideal low timing range is somewhere over here around 12, just a day before Christmas to a day or two after New Year's. So this all points to a weak negative period through December. It's all lining up very, very well. So what I showed you here is just the short-term charts. The intermediate term charts still are positive and still are giving positive momentum conditions. That is in alignment with what we believe will bring a decline of moderate proportion down towards the end of the year, and then another advance, which takes the market up through sometime towards the end of January before we see a period of very severe risk as we get into February, March, and maybe even early April. That's a little longer term perspective in this short term view of the stock market. I hope you found that extremely valuable. Don't forget to get the SIR Daily, and you can get that by taking advantage of our special. We're down to the last couple of weeks right now for this holiday special where you can get become an askSlim member for the lowest prices ever. We are going to give you a bonus gift if you give this gift to somebody else, or if you give it to yourself. We're going to send you back an Amazon gift card, the size depending on which level you do become a member of, and you're going to find this to be fantastic. These are non-recurring. So in other words, you're going to get this subscription or give this membership for 3 months. And then if it's for you or anybody else, you have to decide whether you want to resubscribe again. So there's no renewing in here. It will not recur. No, the only charge to the credit card will be the first one. And then we're going to send you back a gift card and you can get that information as to what the gift card size is by clicking Learn More. Go to the top of the askSlim front page, askSlim.com. Click on Learn More, and all the information is there as to what's included in every membership. And of course, if you have any questions, write to Matt at askSlim.com, and he will be able to answer that for you. Our special Give the Gift of askSlim for 2022. This is the lowest prices you'll see this year, next year, and just an unbelievably great opportunity to learn the style of analysis that we present that you can see is just loved by so many of our members. Please go to askSlim.com, explore the website, share, follow it. If you're brand new, get acquainted by becoming a free member. Subscribe to our YouTube channel. Make sure you give this a thumbs up, and that helps us. And watch member videos in the playlists. I think you'll learn a lot from doing that. On Twitter, follow us at askSlim. And make sure that any questions you have, write to Matt at askSlim.com. I want you to be so unbelievably careful. It is so crazy out there. And I'm always wishing you great trading.
Well, I'm going to sit